Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. We saw some data out in China today. Chinese annual inflation actually dropped for August from 2.7%, the yearly rate the month before, to just 2.5%. That's very welcome news indeed, and goes in the face of what obviously is happening in other parts of the world. China, with its lockdowns, obviously in a different place in the overall economic cycle, and sort of confronting its challenges in a slightly different and probably more nuanced way than the sledgehammer effect of central banks elsewhere in the world as well. So a more complex, nuanced economic structure there and policy response at least is seeing inflation, for the moment anyway, roll over in China. And it does look good because that was the yearly rate, but the monthly rate in prices overall actually fell 0.1% in August. So that's very promising indeed for a rollover of inflation and for it to avoid reaching anywhere near the catastrophic levels of Europe and the United States, and the UK. Also, what was encouraging is that producer prices in August also moderated to an 18-month low of around 2.3%. So that was a very good outcome there as well. And it suggests there isn't a lot of real build-up of pipeline pressures to drive inflation over the medium term. So room to maneuver there for the People's Bank of China, and a rosier outlook for the potential for the economy to stabilize and to begin to grow again. As I've said numerous times, however, anyone expecting, and I know Goldman Sachs recently forecast that China would return to previous rates of growth. Well, I mean, that's just a nonsense. That's not going to be happening. China's growth path going forward as a mature capitalist economic system, and really it has gone in that direction domestically, is really towards a growth path of 2 to 5% range, something akin really to the West. So do not expect the China boom to happen again, but it is the world's third largest economy, and to be growing in the 2 to 5% range will be very positive indeed for continued resources demand, but not in the big leaps up that we witnessed in the previous 10, 15, or even 20 years for China. That could bring some downward pressure to bear on, for instance, Australian mining companies who particularly market to China. It doesn't mean they're going to see a decline in orders, but they're not going to see the continued robust growth in orders that they once saw. Also, given that the Chinese-Australian relationship hasn't really got the restart many of us hoped for with a change of government, and the situation there is that China really actively does pursue finding other markets to buy its resources from wherever it can. Now, the economic outlook, as I said, is modest for China over the long term, modest by Chinese standards, normal by Western world standards. And the outlook for manufacturing, although we did see some good manufacturing data in parts of Asia today, it doesn't offset what has been a rather strong, weak sweet, if you like, of really worrying manufacturing data for most of Asia of late. So again, that is a pressure that will be felt in Australia in terms of a slowing of mineral resource demand growth. On the agricultural front, though, I've continued to say for the past 12 months that Australian agricultural industries are very well placed to do very well going forward, with the caveat, as long as they're not affected by the decline in Australian-China relations, which many have been profoundly impacted by. So just be careful of that. But otherwise, the agricultural sector should remain very strong, particularly for staples, for exports out of Australia. Elsewhere in the world, really, we've seen some scattered data, but the big event, of course, was the ECB raising interest rates by 75 points. I think the market saw that the ECB was hiking by 75 points, and Chairman Powell of the Federal Reserve was talking tough on inflation again. Those things combined to sort of make a lot of people in the market feel, well, This is all the worst case scenario stuff. This is probably the bottom then for prices for the moment, because all the bad news is now out. A little bit of sell the rumor, buy the fact, but it's more like sell the rumor and go neutral on the fact rather than aggressive buying here. I don't think we're going to have a big upswing like we did last time. I think we're going to have a modest move sideways, slightly higher for stocks. I wouldn't be surprised if stocks top out again in the next 24 hours, or they could kick on for 1 or 3 days. But the overall downtrend for US stock market, Australian stock market, European stock market is likely to remain in place. The ECB will be hiking aggressively going forward, and that's going to put considerable ongoing pressure on European equities. It's a slight relief factor for the euro currency, but again, more of a short-term phenomenon than a long-term one. I do think there is continued downside risk for the euro in the big picture, just a little bit of stability for the moment. Over in Australia, I think equities look quite weak. I would be selling this rally. I think the Australian dollar, let it have a little bit of a bounce here. A lot of people are taking profit on long US dollar positions at the moment. Markets don't go in straight lines, they zig and zag, so it's having a zag at the moment. I think the big zigs, though, are going to remain to the downside, or to the upside for the US dollar, to the downside for the Australian dollar. So I'm still bearish the currencies, bullish the US dollar. I'm still bearish stocks. I'm sort of neutral on gold and oil at the moment, but I'm constantly looking to buy oil. I really do think this is a market that's become speculatively short that could rally. I did say yesterday that it might be time to start buying the yen, and it has certainly stabilized over the last 24 hours. We'll just see if that can kick on. But I do see some consolidation for stocks, still a bad trend. Some consolidation for the US dollar, still a bull market, and looking for an opportunity in oil, because if oil were to turn up, there's a lot of people that have to get out of short positions. It could be a very powerful, very quickly rewarding position. So far, of late, though, I've been wrong on oil. I hope you have a very good weekend. All the very best. Clifford Bennett, Chief Economist, ACY Securities.